Go ahead and take it away, Tanner.
Alrighty, thanks, Blake. It's been quite a wild year so far when it comes to the markets, economy. Um, some of it seems a little bit, maybe self-inflicted. Other things are kind of out of our control. But the market's been quite volatile this year. And I think in previous years, we've kind of gotten lulled to sleep thinking, oh, the market just kind of, tiptoes upwards. So this year has been kind of a wake up call back to reality, um, reminding us all that you do indeed need to take a little bit of risk in order to generate some good returns. So let's get right into it. We're going to start by talking about where we are today, how 2025 has kind of gone so far. We'll talk about the Fed and monetary policy, um, and interest rates and economic indicators and data like inflation and unemployment. We'll talk a little bit about tariffs and our trading partners, and kind of where the stage is set at this moment. And then we'll finish up with a little bit about what we're doing in the portfolios, what we see as opportunities, and kind of where we've been a little bit as well. Um, so, starting off with the market so far this year, we'll break it down between equities, or in other words, stocks, and fixed income, or in other words, bonds. Um, this is a chart that shows the S&P so far year to date. So from January 1st of this year to yesterday's close. So this doesn't include today. Today was a pretty mild day. I think the S&P was down 0.03 or something like that. So
Yeah.
it's a pretty good chart for where we are. Um, and let me see. I'm going to try to pull out a laser pointer here so that I can point to specific things. Hopefully, you all can see that. Um, so this horizontal line shows kind of the level that the market closed at yesterday. And as you can see with the S&P, we're actually up from where we started the year, just barely. Um, the market was kind of riding along nicely until about mid-February, and then all the tariff rumors started to pick up. And so the market actually dropped quite a bit in late February, early March, and that led into what the Trump administration called Liberation Day, right? So upon Liberation Day, a whole slew of tariffs were announced, and it was way more aggressive than the market was expecting. And so you saw quite a big drop in the market in the following days. But this is a good reminder of why it's important to stay invested, because almost as quickly as it dropped, it returned um, within essentially 3 trading days. So again, it's another reason to try to kind of detach your emotional self. It'd be easy to say, "Well, look, the market's selling off. Let's sell to ward off the risk of this." But if you were selling at the bottom there, then you wouldn't get to participate in the comeback, which happened very quick. As you can see, the market was almost all the way back to where it started after just a few days. To where we are today is clear above where we were before Liberation Day, but not quite to all-time highs yet. All-time highs would look like something up here. So we still do have a little bit of room to go before we're setting new marks in the market. Again, the S&P 500 is typically what people use to measure the American stock market. I'll also show you a chart with the Dow Jones Industrial. This is a smaller basket of stocks that are a little bit less tech focused, more industrial focused. Um, the Dow actually, it's certainly recovered from the from Liberation Day, but it is not yet recovered back to uh, where we started the year on January 1st. So still down 1%, and then obviously down from all-time highs. Um, two more here. Small caps. So these are smaller companies, still down quite a bit from where we started the year. Again, retrace the Liberation Day, but still have 6.25 to go until we get back to even where we started the year, and then even more to go for all-time highs. And this small cap is actually where we see a little bit of an opportunity right now, because it's lagging the other indexes and because of some of the things we anticipate with interest rates and market conditions that might be favorable for these smaller companies going forward. So something that we're maybe taking to look advantage of for growth oriented clients. Um, Last chart here, with the candlesticks, that's the type of chart we're looking at here, is for the bond market. So bonds up about 1%. One thing that you'll notice, maybe if I go back to the small cap, remember on Liberation Day, it was a quick drop with a quick return. Well, look at bonds. On Liberation Day, actually had a quick jump. So bonds, upon the announcement of tariffs, actually went up right away. And then during the recovery, they kind of retraced back down. And so this is a good example of why we use different types of what we call asset classes, because they're non-correlated. They're diversified from each other, and they're almost a hedge against each other. So on that day, for essentially all of our clients, we have a mixture of stocks and bonds. And on Liberation Day, yes, of course, the stock portion went down, but the bond portion actually went up. And so that kind of helps stave off some of the losses that would have been incurred if we were just, say, doing 100% in an S&P 500 fund. It's the reason why we have different types of investments is because um, you have these other vehicles to lean on when times get tough and your stocks are struggling. Um, okay, so now let's take a look at a much nicer graph. That's I'm going to explain as it's what we call the yield curve. So on the left here, these are different yields. So this would indicate a 4.25 yield right here on the very left. And then as you go out to the right, these are different maturities. And we're speaking specifically about treasuries. So these are bonds issued by the US government, not states or municipalities, but the United States Treasury Department. Um, as you can see on the short end, it kind of goes up for a little bit and then starts to slowly work its way down until we have what we call kind of like a belly in the curve, and then it goes back up again. So this is a little bit interesting. Normally, you would expect yield curves to go kind of up and to the right. For example, if you're locking up your money in a bond, you're essentially loaning that money to, in this case, the United States Treasury Department, and they're going to pay you some interest for locking up that money for essentially loaning the government money. You would expect if I'm only locking up my money for 3 months and then they're going to pay me back versus 3 years, intuition would tell you I should get paid more for the 3-year bond than I should for the 3 month. But that's actually not the case right now. Right now, 3-month bonds are paying a 4.41% yield, and the 3-year bonds are only at 3.9. So why would that be? Well, it's because of where we expect, where investors expect interest rates to go. Essentially, what this is telling you is we expect over the next couple of years interest rates to come down, and then right around the 3-year mark, we expect maybe the Fed to start hiking again. So the Treasury yield curve is really closely matched to what the market is expecting the Fed to do with interest rates. Okay, and so this is the same curve down here in blue, but we just added another line that is essentially, again, the yield curve. It's just what it was in June of 2024. So exactly a year ago, this is the interest rate scenario we had, and then this is the one in blue is the one that we have today. So you can see interest rates were much higher. The Fed started cutting in September, and they went and cut through December. They ended up cutting a total of 1%, which you can kind of see here. Um, these
Mhm.
rates were at about 5.3, and now we're at about 4.25. So just about 1%, which is the amount that the Fed cut. The yield curve used to be much more inverted. Um, right now, we kind of have a partial invert, but it is starting to do what we call normalizing, which is where it goes more towards an upwards and to the right looking yield curve. Now, one thing I want to mention, when we are buying bonds, we like to do what we call laddering. So it's almost a way of diversifying your interest rate risk. And this is essentially buying bonds at different maturities and taking different rates along the yield curve, so that when rates change, you're not beholden to one specific rate. And I'll give you an example. So you might think, let's say a year ago, you're looking at this interest rate scenario. You might think to yourself, well, this 3-month bond seems to be the highest paying. It looks like it's gotten all the way to 5.5%. Why don't I just put my whole bond portfolio in that 5.5% and get the highest rate? Why would I choose to do something out here and get paid less and lock up my money for a longer amount of time? Well, I'll give you an example why. Um, let's take this 2-year bond as an example. So uh, call it 4.7% yield that you're locking in for 2 years. And this was back in June of last year. So in June of 2024, you essentially are buying a June 2026 bonds. You're going to hold it for 2 years. You're going to get 4.7%. Now imagine a year goes by and it's today. Well, this is the interest rate situation. So a year's gone by. So now your bond has essentially got a year left. So now it's in this category. The 1-year bonds are only paying 4.1. So you had a bond that's paying 4.7, but the market is seeing bonds of 4.1. So what do you think that does for your bond? Well, it appreciates. Now your bond is much more attractive at 4.7 than what you can get on the open market. So what do we do about that? You essentially have two options. You can sell it and say, okay, I made a nice profit. My bond appreciated. I'm going to sell it before that bond price comes back down. Well, if you do that, then you have to go back out and buy other bonds that are back at market rates. So typically, what we do is we just say, hey, we made a good decision locking in that 4.7 ahead of time, and we're just going to ride that 4.7 out until the bond matures. So essentially, you get an above market rate by choosing wisely ahead of time. So that's kind of an example of why it's important to not just look at a yield curve and say, where can I get the most yield? You want to be diversified amongst this curve so that whatever happens with rates, you've got an opportunity to continue for growth and for performance. Okay, so now on to the Fed and monetary policy. So monetary policy is essentially just what the Fed is doing. Uh, the opposite or the ulterior is fiscal policy, which is what the government, the Trump administration in this case, is doing. The Fed chairman right now, Jerome Powell, uh, produces monetary policy, which can either be expansionary, which is usually meaning interest rates coming down, or contractionary, which is where you put the brakes on the economy, usually because of inflation, and that's when interest rates are being hiked. They actually had a meeting today. So at 11 o'clock today, they released their updated projections as well as their news about interest rates, which was kind of non news and what the market expected. They did not change interest rates today, which they haven't since December. So December was the last cut, and ever since then, they've held. True again today. Uh, I mentioned they did, however, release new projections, which they do on the third month of every quarter. And that was what was interesting to me and to Corey and to investors alike, because they essentially tell us what they're thinking or what they are anticipating with interest rates, inflation, unemployment for the rest of the year and actually beyond. Um, and then I'll also just hit on the Fed's dual mandate. So the Fed has two objectives: to keep inflation down and to keep unemployment down. Both inflation and unemployment are things that we don't like, and they tend to work against each other. So unless you're in a really dire situation, and there are times that happen like this when monetary policy gets really messed up, but for the most part, you're not going to have inflation and unemployment together. So the Fed just can kind of look at one or the other and decide what's the bigger pressing issue, and then make policy around that. For example, in the Great Depression, we had really high unemployment. That it was a big problem. Obviously, nobody could find a job. The economy was contracting. But what we didn't have in the Great Depression was inflation. In fact, we had deflation. Prices were going down. So they actually created the Fed out of the Great Depression, but around that time. But the the Fed didn't have to worry about inflation when we were in the middle of Great Depression because it was all about what the employment situation was. Prices weren't going up because the economy wasn't contracting. Conversely, a couple of years ago, like 2022, we had inflation of 7, 8, 9%. Really high inflation. Prices were going up. Oil prices were going up. Everything was. Um, but at the same time, we had all-time numbers in terms of employment. The unemployment rate was down to about 3.5, which is historically low. So you can see they tend to kind of work against each other, which is good because then the Fed can just focus on what's the more pressing issue. Right now, as you'll see, it's hard to kind of decide for them. So for the most part, they're not doing anything because they feel like there's not one or the other that needs a move right now.
Right.
So here are the projections. And I know there's a lot of information on here, but we're just going to focus to start here on this first column of numbers. So these are the projections for the end of 2025. This is what essentially, when we're talking right here, GDP, they expect to be at 1.4% at the end of the year. The number right below it, the 1.7, that's what they were projecting at the last meeting or the last time they updated the projections in March. So you can see their projection for GDP went down over the course of 3 months. And you'll notice for each of these metrics, in fact, they kind of have a worsened outlook. Unemployment, they ticked up from 4.4 to 4.5. And PCE inflation, which is an inflation measure that the Fed uses, they ticked up from 2.7 to 3.0. They also do a core in PCE, which is just where they take out energy and food because those tend to be really volatile, and the Fed sometimes feels like they don't have any control over oil and energy prices. So sometimes they just exclude those to say like, what are other things and prices changing? That's what the core is. Also increased from 2.8 to 3.1. The one thing that did stay the same was where they expect interest rates to go by the end of the year. So what does 3.9 mean? Well, currently we're at 4.4. So 3.9 would indicate 0.5% of cuts. Typically, this is going to come in two cuts of 0.25%. That's what they had in March as well. So they held firm with that. There were a lot of analysts who were thinking they may drop that to only one cut in this projection. But I think the market, for the most part, liked that they did keep it at the two. Um, and so, just a reminder, these are the Fed's numbers. The market has a different set of expectations, but right now the expectation is also for two rate cuts in the market, um, with the first one projected in September, or at least that's what the market is betting on. The Fed doesn't tell you when, they're just telling you at the end of the year what they expect. And then you can look at 26 and 27. Essentially, they're projecting one cut in each of those years, 26 and 27. Um, so it was interesting to see that no movement here. The market actually took that as a positive. What is not very good is that each of these metrics kind of went in the wrong direction. You
Mm.
want to see GDP going up, not projections going down. You want to see unemployment going down and inflation going down, and yet they both went up.
Tanner, would you correlate those changes particularly with what's going on with tariffs and trade negotiations? Do you think that's a huge factor into, the
Yes,
downward revisions for each of those
right.
metrics?
Yeah, of course it is. Tariffs are going to. It's kind of like an outside. Anything that is interrupting free markets is going to have um, some sort of an effect on the overall picture. You may have a really good reason for a tariff. Maybe you're trying to protect a certain industry, or you maybe you have motives that are not economic for implementing tariffs, and I'm trying to kind of speak generally here. But whenever you implement a tax, it does kind of disrupt the natural flow of things and tends to slow the market down. And so that's what you see with these updated projections. Remember, the last time was in March before the tariff, before Liberation Day and before all these tariffs were released. So this is the first time the Fed's releasing projections after all the tariff stuff has come out. And so they're essentially saying they're a little worried. Now, these are not massive jumps, but the Fed is basically saying we think that there's going to be a little bit of a negative effect in the short term from the tariffs. I will caveat that with the the chairman Jerome Powell said that they have very little conviction with these projections, meaning um, they don't feel very confident because they don't know, they haven't been able to quite understand how the tariffs are really going to affect the economy. He did make mention of this summer being really important for determining, how the tariffs are going to affect the economy. Um, so essentially, he's trying to say take these numbers with a grain of salt because we do feel like we're a little bit guessing here.
Mhm.
Okay, so the Fed's dual mandate. Let's start with inflation. Here is the PCE inflation over time going back to about 2016. You can see in 21 and 22, we had pretty high inflation. And now it's come down all the way to 2.1 at the last reading. Well, the Fed's target is 2%. So we're essentially where the Fed is at least saying that they want to be. However, on the last slide I showed you, they're expecting this number to be 3% by the end of the year. So they're also saying we expect inflation to go up. I always want to make this clear too, because I think sometimes people can confuse like what inflation actually is. It's changes in price, and this is a graph over time of the change in price. So essentially, anything above zero is increasing prices. So it's important to note that even though the graph is going down here from 9 all the way down to where we are now at 2.1, it's not deflation. This doesn't mean prices are going down. It just means that they're going up slower. Usually when you have prices going down, that means that you've got serious problems in the economy. And as much as we'd like to, be able to buy things cheaper than we do today, it usually means that you're in some sort of a recession. So this is what the Fed is trying to achieve. They call it disinflation. It's essentially a slowing down of inflation or a deceleration. But don't get it twisted. Prices are still going up. They're just going up slower than they were. Okay, unemployment. So you can see this line kind of coming in and lowering, and then we get the COVID spike of unemployment, and then back to lowering all the way to today. We're at 4.2. The Fed's projection, or what they, not the Fed's projection, but what they are trying to achieve is 4.2. That's their target. But they do expect by year end to be at 4.5. So they expect this to tick up, as I mentioned before. One thing we found particularly interesting was a tick up in recent college grads on unemployment numbers. So this can be thought of lots of times as what we call a leading indicator. So it's maybe a sign of things to come, and an increase in unemployment here is not a good thing to see, because if you're a business, for example, lots of times the first jobs to be cut, or the first positions to be essentially not hired, maybe taken off of job sites and that sort of thing, are going to be entry level positions. And so when you see those start to go, it can be, in this scenario, I would say it can be one of two things. One thing would be it is a sign of things to come, and you might see, the recent college grad line is in blue. You might see this black line, which is the overall unemployment numbers, start to tick up with it as well. And that's what the Fed has told us is probably going to happen. And higher unemployment will typically lead to poor outcomes in the economy, and therefore poor outcomes in the stock market, right? There is a caveat to this, and it has to do with AI. It's possible that the increase in unemployment for recent college grads is due to AI, and it's a lot of positions that maybe companies were hiring for before, but are now using software and AI to kind of accomplish those tasks, and therefore they're not needing to hire someone. This is obviously tough for our kids coming out of college. The economic implications of that, however, are less dire. Essentially, the stock market is based on not necessarily what the consumer is doing, but it's what companies are doing and how successful they are. And if companies are able to save money by implementing AI instead of hiring someone, that actually might be a net positive for companies. So you could look at this statistic and, on the one hand, say, well, unemployment's going to rise. We're going to have issues in the economy. We're going to have issues in the stock market. The other way to look at this might be said, well, the issues in the stock market might be staved off if it's just because these companies are using AI instead. which would then mean that their profits are going to be okay. So two ways to look at that. This is a last slide on unemployment here, and it's the unemployment claims numbers. So the bars in blue are continuing jobless claims. So it's like the total number of jobless claims, and you can see it's pretty steadily rising up until the last reading was actually quite a bit higher. The yellow line is initial claims. So these are people who probably just lost their job and are filing for unemployment the first time, rather than someone who's been looking for a while and continues to look. In either case, both pointing to higher unemployment. Okay, switching topics to tariffs. Tariffs, global trade. We're going to talk about a little bit about our trading partners and where the progress is with those deals, and the tariff negotiations. One thing I think we all might find interesting is China is actually our third largest trade partner. This top section here shows it's actually, it shows our largest trade partners, which is when you add imports and exports together, it's actually Mexico who's our largest trade partner, with Canada in second. Upon reflection, that makes a lot of sense. They're right here. So it makes sense that we'd be trading mostly with them. But I think a lot of people would have thought China was our number one trade partner, and they're actually third. China is our second largest import, so we import the second most from China, behind Mexico. We export third most to China, behind Mexico and Canada. Here's just a quick slide on where we are with China, because I think a lot of people are interested in what our relationship with China is. It has a lot of effect on certainly the stock market, but our economy as well. If you start from the beginning of the year and where tariffs were and taxes on China, the blue line is the additional tariffs that we've levied, the U.S. on China, and the orangish reddish line is what China's done. So you can see here's Liberation Day, and then China and the U.S. both, China retaliates and the U.S. retaliates, and then they both come to an agreement here to bring them back down to 30 and 10. So the U.S. levying 30 on China and China levying 10 on the U.S. We're currently in the middle of this section, and they're working on negotiations right now to come up with a deal for when these expire in August. Before I move on to with tariffs, there's so much news coming out day to day that the market, I think, at this point has kind of taken a wait and see approach. I think in the beginning, the market was trading on every little rumor, and every time Trump posted about a certain country, you would see stocks move all over the place. Now I think there's more of a wait and see attitude, because things change so rapidly and rumors are false and then they're true and then they change. So if anybody's interested in a more in-depth tariff conversation, please feel free to reach out to us. We could go through every country, but we'd also be here until the morning. And each country is kind of in a different spot. The U.S. has, I've heard talk of them being close with India, close with the EU, and
UK.
close with the UK, and we still haven't seen like any really fully signed deals yet. But I guess it's important to note that the Fed or the Trump administration did levy a 10% tariff across the board, so that is in place for everyone right now, while things are negotiated behind the scenes. Um, and when it comes to the Fed and the markets trying to figure out what is going on with tariffs, I don't think really anybody knows. So the market is going to react when we get a deal done for a country. You'll see not only companies from that country change in stock price, but also companies that manufacture there, companies that sell there. There's a lot of ripple effects, and this is why the Fed is not very confident in their projections, because there's a lot to come in the coming days when it comes to these trade agreements. Okay, last section here. I'm going to talk about, Corey and I both are going to talk about our active positioning at Anchor Bay, what we're seeing and how we're positioning the portfolios in different scenarios. I'll start by talking about the bonds, and then I'll pass it off to Corey, who will talk about stocks and some of the industries that we are viewing favorably right now. Here's my trusty yield curve graph again. And it's just here to briefly make a point about, we talked about why it's important to ladder, but I'll also say that when I look at a curve like this, which is the current scenario we have, we are probably going to stay away from what we call the belly of the curve. If I can stay at, let's say, a 1-year bond and get 4.1, it doesn't feel like it feels like a little bit of a stretch to dip below 4 for a 3-year bond. And if you waited a couple more years, then you're back above that 4% level. So we typically will do less buying in the belly of the curve, but it's not impossible that we would buy down there. It just is somewhere we'll probably avoid. In the end, the analysis for buying bonds is always going to be, are we comfortable with what we're locking up for that time frame? And I would say anything around 4% is pretty good. We tend to think of 4% as for someone who's in retirement, a safe withdrawal rate. If we're able to generate 4% from one of the safest investments out there, which is treasuries, and send out all that interest to our clients for them to live off of without having to sell something or dipping into principal, that's a pretty good deal. And so a lot of times anything around 4 or above 4%, we're going to take, kind of regardless of what we expect with interest rates going forward. Okay, and before I pass it on to Corey, who'll go over stocks, I just do want to mention, we have a lot of different types of clients with different risk tolerances and time horizons and investing objectives. And so we've built out different strategies that correspond with those objectives and those needs for each client. We pride ourselves on being highly customizable. So someone who is 10, 20 years away from retirement and they're not planning to touch their account until they're in retirement, and they're comfortable with riding out the ups and downs of the market, that person can take on a little bit more risk. And in the stock market, it's a risk reward trade-off. Whereas somebody who is, let's say, already in retirement generating, and we're needing to either generate income or protect what they've spent their whole lives building up to, the investments are going to look quite a bit different. We're not going to want to take as much risk in that portfolio. We don't have time to ride out the ups and downs. We need to preserve what has been saved up, and if we can get a little bit of growth along the way, that's great. But normally for those individuals, we're going to be okay giving up some upside if it means protecting on the downside. And so Corey's going to go over 3 different scenarios. 2 of them are in the former, the more growth oriented strategy, where we have kind of a longer time horizon and we're able to take a little bit more risk to try to generate more growth. And then the last one he'll talk about is more suited for a more conservative type approach where we're more interested in preserving capital and beating inflation than we are trying to keep up with the market. So Corey, why don't you take it from here?
Sure. First of all, I want to thank all of you guys for being here. Typically, when we go in depth with a lot of this investment and finance talk, it goes over the heads of a lot of people that might not want to listen to the full extent of what we have to say. It's usually conversations that Tanner and I have on a daily basis, and it's very nice to see that there are people interested to learn a bit more and see how we can kind of translate our ideas and strategies into how we're actually making actionable trades within client portfolios. So thank you guys for being here, and hopefully I can break down some topics here that and ideas that we're seeing for portfolios here at Anchor Bay. I think first thing is going back to the Federal Reserve and Jerome Powell. I think it's safe to say that even just a year ago, Jerome Powell and company with the Federal Reserve had a much easier time of tracking fewer uncertainties. There was pretty much a huge uptick in inflation, and they had a mandate to bring that down via high interest rates. And there was a geopolitical event with the Ukraine and Russia war starting in 2022. But beyond that, there wasn't too many wild cards in terms of bringing uncertainty to decisions. So a big reason as to why we're not seeing very quick changes in interest rates for the time being is because there are so many wild cards. We have another geopolitical event with the wars that are happening within the Middle East with Israel and neighboring countries. You still have the Ukraine and Russia war going on. And then you also have new spending bills like the big beautiful bill that's being proposed and attempted to be passed, which will add more debt, more deficit, but will hopefully bring more growth to the economy is what the goal is. But all that being said is there's a lot of noise going on, a lot of tweets, a lot of things that are very distracting for a lot of people if you just look at the news. But part of our job here is to identify trends and industries that are able to poise well, not just now, but going forward for the foreseeable future. So with that intro, I wanted to just break down a couple of industries here and what we're looking at. And related to the geopolitical events and some of the escalations we've seen within Middle East as well with Russia and Ukraine, there's been a huge uptick in military spending, and not just from the U.S. but from parties abroad. So as you can see here, the 2026 military and defense budget that's planned from the U.S. is going to top $1 trillion if it's passed in 2026, and that would be the first time since 2010, 2011 when there was more of the Iraq and Afghanistan wars going on, and we got more involved. So you can see it was at 999 billion. Well, 2026 is going to be the first year that we actually top that. And that has a lot of spending related to weapon systems, intelligence, broader defense mechanisms. There's a couple of different sections there, and which means there are opportunities for companies that operate in those spaces and market leaders to take advantage of that heightened spending. Now, also, something that's very unprecedented is that the EU, starting in early 2025, they announced that they're going to, meet an 800 billion euro, this called Rearm Europe package, where they're going to actually come together as a coalition and spend a lot more than what they previously had. And you'll see that in the next slide. But again, we believe that there's plenty of opportunity with names like Raytheon, with L3 Harris, Hanwha Aerospace, General Dynamics, and even some Boeing too, where a lot of these companies are very diversified across the aerospace and defense sector, or industry rather, and they're market leaders within that industry. So we're actually paying attention into ways that we can either allocate more towards these names or introduce new names to the portfolios. But that's just a little bit about the U.S. spending. If you go to the next slide, you'll see this is exacerbated through what the EU plans to spend. Now, this is seriously unprecedented. You can see on this chart here that military and defense spending actually stayed fairly stagnant for the better of 10, 12 years. It wasn't until the escalation of the Russia and Ukraine war where we saw the NATO coalition really try to bring countries to spend 2% of their expenditures on defense at least. And that has definitely come through. And we can see that where it's almost going parabolic from where it was back in 2020 and 2019. So it's a huge transition and a huge paradigm shift that will definitely see tailwinds for the aerospace and defense industry. And I think Tanner wanted to touch upon as to why aerospace in particular. So you had something there, Tanner?
Yeah. With Trump, the Trump administration 1.0, they introduced a new military branch, the Space Force, and our thinking is, since that stamp is kind of under the administration, under the Trump administration, it's conceivable that that arm of the military gets a little extra spending to kind of cement the legacy of Space Force as a branch of the military. And with all the tariffs and everything going on, we haven't seen a ton of that yet. There has been some of it, certainly, mostly to do with regular defense. But Corey and I feel pretty strongly that we'll see some more specifically aerospace pick up. And some of the names that we picked are well positioned to take advantage of that direction.
Yeah, so going on from aerospace and defense, another industry that we're particularly interested in gaining more exposure to and trying to find newer names is really playing off of this artificial intelligence theme that we've been hearing all the time in news recently. And it's very easy to see that there are very clear beneficiaries. A lot of the times, I'm sure everyone has seen NVIDIA in the news, perhaps some of the big tech names that are listed here. This chart basically shows you all of the capital expenditures or investments that these big tech companies are making year over year. So you can see this is Meta or Facebook, rather, before they changed their name, Google or Alphabet, Microsoft, and Amazon. So these are four of the biggest tech firms and even biggest companies in general globally. And you can see CapEx is growing rapidly. Now, where is this CapEx going? A lot of it is going towards building data centers and building the infrastructure that is required for data centers. So when we're thinking about opportunities within this industry, and it's a very quick growing industry, we tend to like to go not just to the first layer of very obvious beneficiaries like NVIDIA. We like to look for kind of what we call the second order beneficiaries. Now, a couple of examples of what this might be are even your traditional utility companies. So it's, again, a very unprecedented forecast that we have where electricity demand has been fairly stagnant for the better half of 20 years since the start of the 2000s. And it wasn't until last year when ChatGPT really became a lot popular and that conversation around AI really brought to light how much electricity is actually needed to compute a lot of these algorithms. And a huge benefactor of that massive increase, which is essentially doubled. And even though it's going from 3% of electricity demand per year increase, it's now up to 6%, which is 100% increase or a double. And that's, again, for these traditional utility companies, which are always boring, always more income-driven stocks that you would buy to generate income for their dividends, and not really expecting much growth. There's a huge paradigm shift here. So one company in particular that is kind of in the middle of a lot of this data center construction and supplying a lot of the power is NRG. Now they're based out of Texas, and like I said, they have a couple of contracts with bigger tech companies to supply energy to these data centers. Now they're doing it through traditional measures like with natural gas and other oil sources, and they're also branching out into other cleaner energy sources that weren't typically used as much. But as you'll see in the news going forward, you're going to hear a lot more about nuclear. You're going to hear a lot more about cleaner energy to help meet that demand for data center power generation. And they're one of the companies that are right in the center of that type of growth. Now, the other kind of name or industry that is important to kind of think about when you're thinking about this huge build out in data centers are the real estate companies. Now, if you can, really think about it, someone has to be the landowner of where the data centers are built, and they have to be the landowners that are collecting those rent checks every month or every 6 months, whatever the contract says. And if you go to the next slide, Tanner, you can see that. And sorry, one more to the vacancy visual. You can see over the years, data center vacancy has dropped dramatically. Now it's obvious because this AI technology is becoming a lot more popular, and it's very clear that's going to take a lot more energy. So naturally, vacancies come down for those tenants. And then you can also see the rapid growth in terms of rent amounts for these data center pieces of real estate. So it's very clear that these real estate companies that already had experience being in the industry, like a Iron Mountain, which we've looked at and held for quite some time in various portfolios, they are a very interesting story where for the very beginning, they were a data management company, and they were a physical data management company, which means they held literal paper and file cabinets in very tucked away places. And one of those tucked away places are mountainsides where there was enough space at the bottom where there could be plenty of surrounding area to make it more secretive, if that makes sense. Now, what they've done, and a lot of their customers were like the government, basically wanting to store very secure pieces of data and very off-center locations, as well as corporations wanting to seal more secretive data. That's how Iron Mountain got their start. Well, now that they've grown and they've really diversified their business and who their tenants are, they've taken a lot of those secretive underground locations and converted them to data center operations, because it's naturally cool when you're talking about locations that are near mountain areas, and especially when it's blocked off from the sun. And there's just a lot of different benefits for being the locations that they're at. So it's very interesting to see how a company like that can, kind of change their whole, business operations to kind of change with the times, and they're doing it quite well. So it's just, those are two different, more boring, traditionally boring industries that are taking advantage of a very quick growing paradigm with AI and data centers. So,
and we really like these, like Corey mentioned, these second order companies. It's almost like the pickaxe theory during the gold rush, right? Where it wasn't people who came out and struck gold that were the ones mostly getting wealthy from the gold rush. It was the people selling jeans. It was people selling pickaxes. People selling, homes or hotels and things like that. It's all the peripheral industries that were built up from this influx of people in the area and doing one thing. It's very parallel to what we see in AI. You'd have a hard time picking an AI startup company. There may be some of those companies that pan out in a major way, or in other words, strike gold, but there's going to be a lot that maybe flame out. These peripheral industries that are going to support AI feel like a much more sure bet. and you're going to get a lot of the same return from it anyway.
And so, yeah, the last piece of information I wanted you guys to take away, and another area that we're really closely monitoring, is the financial space broader, but more specifically, your major banks, your bulge bracket banks, which these are banks that have multiple lines of businesses, anywhere from your normal checking and savings and deposits to your loan giving, and also investment banking arms, underwriting, and then mergers and acquisitions. All these are part of a bulge bracket bank like a JP Morgan or like a Bank of America or a Goldman Sachs. And so these types of companies we feel will poise extremely well going forward because there are multiple tailwinds. Now, a few of those are, if we do have a lower interest rate environment and we do see that yield curve normalize that Tanner was going over for our fixed income strategy, if you start to see that be more of a up and to the right yield curve, it's very advantageous for banks because most of their costs and expenses are associated with those shorter parts of the yield curve where they have to pay interest on savings and on checking accounts, whereas a lot of their revenue comes from the longer end of the curve where they give out mortgages, longer term loans. So if you have lower expenses and higher revenue, if you have a normalized yield curve, it's a very, very advantageous area to be for a bank. Now, not just that, but like we have seen very recently, is that mergers and acquisitions have upticked very, very quickly. So a lot of these bulge bracket banks have these underwriting departments, and when a lot of companies are trying to acquire each other or merge, there has to be an underwriter for that line of business. And a lot of these big banks are those primary contacts for underwriting activities. And then lastly, one of the biggest themes that hasn't really been talked about too much in the news, and I'm not sure that a lot of people are aware of it, is that since the 08 and 09 crisis, there's been a huge uptick in regulation, and for good reason, for a lot of the banks that partook in things that might have been disadvantaged for consumers. Well, with the new administration, there are proposals to bring back some of those regulations, with things such as lowering capital reserves for banks, where they don't have to keep as much money at the bank. They're going to be able to loan out more. So again, that's another revenue generator. More money that they're able to lend out or to use to pump back out into the economy and therefore inspire growth. So a lot of these reasons are the main culprits as to why we want to look at the major banks and potentially, raise the allocations to those. So,
Yeah, that deregulation piece is there's a lot of news and things that get priced into the market, like some of the stuff we already talked about. That one at the end is one that we feel like has not been priced in. So when there is news of deregulation or more favorable rules of engagement for banks, there should be a nice upward shock for some of the companies that we use in our portfolios, some of these bigger banks. All right. Thank you, Corey. And thank you, everyone, for joining. We really appreciate your time tonight. Wanted to see, Blake, did you have anything, or did we have any questions?
I don't see any questions in the chat. If anyone has a quick question, feel free to punch it in the chat. But while you're working on that, as Tanner mentioned, we're happy to set up a phone call with you, virtual meeting, in-person meeting, whatever your preference is, to talk with our investment team and have a more one-on-one conversation with your portfolio. And this will be recorded as well, so we'll make sure that we get this for your public viewing. If you want to access it later, happy to answer additional questions in a one-on-one meeting. That's what we're here for, but hopefully you got some value out of today's conversation. And with that, if there's no question, we hope you have a great rest of your evening. Take care, and we look forward to talking with you again soon. Have a good night.
Thank you, everybody.
Thank you.